Hey folks, welcome to CFO Chat. As always, this is your front row seat with the Chief Finance Officer. Anytime a corporate action happens, you have all the detail here. KCB released a stellar set of earnings yesterday. We are privileged to sit down with the GFD, Lawrence Kimathi. Glad to welcome you back on set.
Thank you, Julian.
It's been a while,
always a pleasure. It's been a while. Happy to be back.
Lawrence.
Asante.
Lawrence, congrats.
Thank you.
That's quite a set of earnings. Green shoots everywhere. KCB Kenya is recapitalized. All subsidiaries ROEs in the double digits. NBK is profitable. The dividend is back. But let me tell you what was the sweet spot for me, is how you managed your net interest margins considering the cost of funds, as well as when you look at your jaws side because of the cost revenue mix. Just give us some color around the earnings you've just released.
Yeah. So on the protecting our names, we take consideration that the fact that a lot of our customers are stretched financially. But with the cost of funds where they are, we've been very strategic in increasing our pricing. We have not gone gung-ho because we don't want to create a problem for us in the future. But we've taken very, very good opportunistic investments in government securities. When the rates make sense, we go in there very strongly, and that has really, really supported our NIMs. Overall, yeah, I agree with you. Very good results. Julian's, when we did the H1 last year, you were one of the ones who was bashing us. And rightfully so. They were not very good results, to be honest. But we were building a base. And that base is not built on sand. It's clearly built on very concrete foundation. And we can see quarter one, very good performance. Quarter two, even better this year. Even in the environment that we find ourselves, especially in our Kenya businesses, we've been able to make lemonade, as they say, when you're given lemons. Very good top line growth that has delivered the PBT that you've seen of about 30 billion.
And really speaking to the issue of tapping into opportunities, especially on the government side, with what we have seen around the sovereign downgrade, how has this manifested in your numbers, and do you see it being a potential challenge going forward?
So we saw, the week after the first downgrade, we saw the shilling losing 4-5% at that particular time, and also all the issues of the Gen Zs. The shilling has since recovered, looking very stable. But obviously the cost of money will go up. So if you're looking to borrow from international sources, that is going to cost us more because of the rating. The reasons given for the downgrade were, the rating agencies were not seeing light at the end of the tunnel in terms of government being able to raise enough revenues to cover their expenses and also pay down their loans. We have seen Parliament has approved, and the President, the appropriation bill, rejigged, how the funding will be done. So I'm hopeful that, and also the IMF support facility, the conversation is being held with the new CS of National Treasury. So I'm hopeful that, that is likely to change very soon. I'm not saying the second half of the year is going to be a bed of roses. It will be tough. Impact of the protests that we saw, the last 6 weeks or so, it will start manifesting, especially for banks, will start manifesting in about 3 to 4 months out. So we will wait and see how that pans out.
Okay. And KCB Kenya looks recapitalized. And I'm curious as to whether this is a reflection of the Proparco and EU money coming in, or this is purely organic recapitalization?
This is purely organic. Purely organic. As I said yesterday, we asked our investors, give us time. We believe KCB Kenya power to generate funds, to generate cash, to generate capital. Give us time. Let us invest what we would have paid by way of dividends. Let us invest that for 6 months, and we shall reward you. And yesterday we managed to do that. The interim dividend. And, very, very good capital buffers. So this is all organic, Julian.
So is Proparco still in the pipeline?
It is in the pipeline. You know, our group CEO signed off something with them in Kigali. In Kigali,
yes,
yeah. So that's it's paperwork now. We're just finalizing. It's in the pipeline. Remember also, our balance sheet does carry a number of other facilities, both senior facilities and tier 2 facilities. With tier 2, you only pay back after 5 years. So we've got one IFC, I think, that is almost at the tail end. We've got a second IFC, which is somewhere halfway. So, you know, we will need the Propaco money as and when we finalize the paperwork.
Lawrence, as we give you your flowers, one of the dim spots in your numbers remains the asset quality conversation. And two things stood out for me yesterday. One is that when I look at your breakdown in terms of stage 1, stage 2, stage 3, one of the things which stands out to me is that when I look at HY24 vis-a-vis HY23, two problems still stand. One is that the recuperation from stage 2 to stage 1 looks a bit slow. And then the degeneration from stage 2 to stage 3 is still nipping quite considerably. Where do you stand in terms of asset quality? Because for KCB, that's a big issue.
Yeah. Well, we don't stand in a good place. You know, we have talked about asset quality for a very long time. It's also a bit frustrating for us as management because we see a light at the end of the tunnel, but at times it's an oncoming train. And it's not a way out. The environment hasn't been very conducive, to be honest. From mid-2022 is when we decided, let's just throw everything in and start cleaning up. We had the elections, we've had the issues that have been going on. So the environment hasn't been very, very conducive. Quarter 4 last year, we also made another decision of whatever seems shaky, let's just throw it in.
Further downgrades.
Yeah, further downgrades. And a lot of that happened in Q4 last year. The good news is we are not seeing, the new formations are very manageable. So the last 12 months, migration is 1.5%. The last 2 years, migration is about 2.5%. So the enhanced underwriting, credit underwriting policies we put together are working. We need to deal with that legacy book. Also our customers tend to be very clever. They get injunctions from everywhere. You want to sell the collateral, a guy rushes to Kitui, gets an injunction. He borrowed from Mombasa. So that is also not, it's delayed the process, but it definitely 18.5% NPL, 212 billion stock is not where we want to be. That's for total assets of about 2 trillion rather. That's a big number.
Oh yes, that's a whole bank.
That's a whole bank. You're right. Yeah, but rest assured, it is something we discuss on a weekly basis as senior leaders. The guys who are charged with the responsibility of dealing with it get the pressure. They get the pressure.
KCB formed a special assets recovery team. How much have they raked in by way of recoveries in terms of a quantum?
Actually, they have. Beginning of the year, we've dealt with 2 state-owned enterprises facilities that had been in our books for a very, very long time. Yeah, so that has been dealt with. We are at the tail end of dealing with another, I would say, 2 government-related and another 4 private, which, there's M&A activity for some of those. The others, government is going to come in and put the funding. So the guys are actually really working. They're putting a lot of work in dealing with this. But as I said, the environment, some of them, I think it would have been easier if it was retail, when it's check-off, smaller facilities. When it's a big one single corporate, you're talking about 4 or 5 billion, that takes time to sort out. Yeah, but as I said, it's frustrating when I stand up to talk about NPL. That slide, I really want to see the arrow going down. Yeah, and that would really be the cream.
Still on the question of asset quality, when KCB ventured into DR Congo, Lawrence, we had a conversation where I raised two questions. One, I'm concerned about anti-money laundering in an environment which is significantly cash-based. Two, I asked about risk pricing in a market which is vastly fragmented and informal. TMB seems to be showing up in the NPLs now.
Yeah, well, true. I'll also say, remember there was an election last year in DRC in December. The CDF, the local currency, franc Congolais, has also taken quite a beating, devaluation, and that's a balance of import and export. The country imports a lot more than they export. So we are seeing some pressure in the macros, in the general macros in DRC. The book, remember, for when we were buying TMB, their core focus in terms of customers was largely SME. Yeah, so we are only just coming in, using the big balance sheet of KCB Kenya to help do syndications. We've done one very big deal on cement. We've got a very healthy pipeline on other, a number of big deals. So we will see a change in a very short while in terms of NPL, both stock and rate. Sorting out the NPL ratio is fairly easy. Just grow your book. Yeah, but we want to focus also on the stock.
Yes, I see. And still on TMB, one of the questions I've been recurrently asking KCB is TMB by its nature was heavily non-funded income driven. Are you rejigging that number now? In terms of changing our focus?
Yes. Not really. I mean, there's opportunity in TMB to grow. Their loan to deposit ratio was 30.
Correct.
Yeah, it was very low. Yeah. So we have actually increased the appetite to about, I think we've given them 40, 45. So there's opportunity in growing the funded side, but there's also a massive opportunity on the non-funded side. Yeah. So, getting the service fee, and they've done quite well in the service fee. They have done fantastically well on FX, because that area they are not playing. The FX income, they are not playing heavily on it. We just got a new group treasurer, came in March, and is gone round, our subsidiaries. That's why actually our FX income has done very well, 69%. So just bringing in new products, new ways of thinking. I believe TMB still has a lot to offer to the group.
Lawrence, what's happening in BPR, Rwanda? Is it an integration issue, or what exactly is playing out?
Rwanda had a very bad June, the month of June. We had to write off quite a big chunk of facilities that we just made a decision to clean up. And when you write off, you means that where you're taking collateral as to support in the ECL. That part, because you've written off the loan, you've got to actually take additional provision to cover that area. So massive hit in terms of ECL for the month of June because of that decision we made. The pipeline is healthy. I was in Rwanda with our group regional businesses director to do a full day business review. Very good pipeline. We believe they should be able to cover that in the remaining part of the year.
Okay, because the number really jumped at me when I saw the presentation yesterday. So looking ahead, we have an environment which has been a bit uncertain here. Costs are really escalating. When you look at yields are quite elevated. How do you see the remaining half of the year playing out for KCB, and what strategies, if any, changes are you making in light of the macros? Yeah.
So for macros, let me start with the interest rates, in the market. Our assumption is that the interest rates will continue being elevated. Yeah, and that assumption is based on the fact that government has to come and borrow more. They were planning to raise 346 billion. Oh, yeah. They managed to reduce that, but they still have to come and borrow. Yeah. So they will be in the domestic market a lot longer. It might serve them well to try and push down the rates, because borrowing that amount of money at that rate
also quite pricey.
Exactly. Yeah. But our assumption is because they will be in there, there'll be a lot of demand, so the rates will stay up. We have also made an assumption that the shilling will sort of hold steady, but the marginal slide that you expect, so your 1-2% slide in, and that's going to be really because of the high interest regime. That supports in a way the shilling. Our biggest concern, and inflation seems to be tamed. Yeah, inflation seems to be under control. Our biggest concern is the impact of what happened during the rejection of the finance bill to the customers, to the general business. 2 days closing businesses, 2 days in a week.
Yes.
And it's not just in one county, it was in almost all counties. That has an impact. Cash flows were hit. Some customers, traders' working capital was impacted, either stolen, burnt, or looted. So what that will do in Q4 is actually where we are concerned, especially on our SME book. Yeah.
Lawrence, as we dial down, one is NBK. How far are we with consummating the divestiture from the business to Access, and are you still eyeing the 1.25x pricing?
Yes. So we are at regulatory approval level. We filed both CBN, Central Bank of Nigeria, and CBK, Central Bank of Kenya. We've gotten some feedback from them, responded. We're expecting now, that there's no objection to come anytime. We are at the tail end of doing the audit, completion audit. So everything held constant, we should be closing the deal before the end of Q3. And yes, the price was binding. It was a binding offer, 1.25 times book.
I see.
Yes.
Does Nigeria recapitalizing the banking sector have any impact?
Yes, I mean the regulator is looking at both. Recapitalize, give us a recapitalization plan. Access is public knowledge. Doing a rights issue, so they're in the market to raise some capital to meet the regulatory requirements. So the regulator is probably going to focus a bit more on that. As once they finish with the capital raising, then they will look at the application for acquisition.
Okay. You must have been really proud of the NBK numbers.
I was. But also remember, last year NBK had a very big one-off. Yeah. That settlement, the legal case settlement. Yeah. And once a company goes into loss making, that has an impact on staff. You're working so hard. When you look at your numbers, they are in the red, so that doesn't help. And I'm really, really proud at how quickly the NBK team has, galvanized themselves and turned it around, and they're making a good profit this year in the environment where cost of funds is quite high as well.
And also with the transaction midway, it could create a number of uncertainties. I was playing with your numbers last evening, and I noticed there's quite a bit of variance in terms of the loan to deposit when you look at KCB Kenya versus the group level. KCB Kenya is playing, I think, in the mid-70s thereabout. The group level is at about the high 60s. Do you intend to bridge this divide?
Yeah. Not really, because we try and look at each environment on its own merit. Yeah. So, for instance, we talked about TMB. TMB will stay around the 40-45 regions, and because it's the second largest balance sheet we have, that sort of will dilute the group numbers. KCB Kenya, given the environment we're operating in, we've been very, very selective in terms of the asset quality we are looking to write, in terms of the customers we are looking to deal with, because we also have this big baggage of NPL hanging over us. We have to be very careful that you're not perpetuating this problem into the future. So that will also be selective. And also, frankly speaking, the alternative asset, which is government securities, is giving you a fairly good return. Yeah, so you have to keep your eyes open to that as well. Yeah, so each country, each business, we look at our lending strategy to fit the environment we are in.
I see. Interesting position there. So the dividend, I need to really give you your flowers at that point, because the interim is back, and really good proposition coming from KCB. Just give us some color around how you arrive at this decision, because, and I always remind guys, if there's one entity which even paid dividends during COVID, it was KCB Group. Yes. And then now you shelved them and the market really punished you. How did you arrive at this, Lawrence?
Well, it's a function of really our capital position. Yeah, so, as I said, KCB Kenya has the ability to really generate organic capital. The capital buffers are looking good. We have the sale of NBK also in the pipeline. So, looking at what do we pay for interim, said we didn't pay, dividends in the full year. There are investors who actually depend on this dividend because the capital is good, and we know we have this sale of NBK that is close to fruition. We can actually give a bigger interim dividend at this time. We close the deal, we continue generating the capital the way we forecasted, then the full year dividends also are not at risk.
I see. Interesting. Lawrence, this market has debated heatedly a legal matter which emerged around one of the banks versus Santowell, around Clause 44 of the Banking Act. Should banks seek approval from the market regulator, from the Treasury actually for that matter, when they are doing their revision of interest rates? Just curious, what are your thoughts, Lawrence?
Well, I'm not a legal expert. But in the various conversations we've had with our internal legal team, that mandate from the Treasury has been delegated to the central bank. That's basically what the legal guys are telling us. But this is obviously being looked at from an industry point, KBA taking that up for conversation, because it is likely to have a far-reaching impact on the industry. Yeah, so ideally the National Treasury would delegate some of this policy authority to the regulator. That's why the regulator is there. So that's where I believe it should stand.
Okay. Final question, Lawrence. The last conversation I had with KCB, there was indication that there was a plan to kind of hive off the mortgage book, kind of bring S&L back as we knew it. Has that been done?
Yes. We haven't done it in the S&L way, i.e. a legal entity. But yes, we have actually brought back mortgage division. We have a mortgage director who's looking now at both the retail mortgage and the corporate mortgage, and being able to give it the attention it deserves. We thought mortgage being a product, throw it into the two divisions. The corporate customers can go to a corporate banking, create a relationship management system on that side, and the retail guys can go to the retail. But we did lose some focus. The corporate guy is writing, 5 billion. This guy who's coming to borrow 100 million might not really get the attention they deserve. So yes, we have created a mortgage division again, and the new mortgage director is pushing that.